So the London Stock Exchange Group is listed on the London Stock Exchange. We are a member of the FTSE 100 index. We enjoy a market cap of about 17 to 18 billion pounds and an enterprise value of about 19 billion pounds. Broadly speaking, we have about 4 business units within our group, those being capital markets, which is the group that I'm a member of. We have information services division, the largest brand of which is FTSE Russell. We have the post-trade and clearing division, the most popular brand within that being London Clearing House, CC&G and Monte Titoli. And then we have our technology business, LSEC Technology, that is in the business of powering other stock exchanges, equity markets, fixed income markets, providing resilience and market trading and surveillance support to those nations. Just in terms of numbers, we provide stock exchange software to about 32 countries in Africa. The global exchange space is primarily London Stock Exchange, the US exchanges, and Hong Kong. What we generally find is there are many motivations why a company chooses a certain listing location. It also has something to do sometimes with the equity investors and the buy side. I think today we are at a position in time where companies at their growth phase, at an inflection point, going from perhaps loss-making to profit-making, if they're at the inflection point where the forecasts are demonstrating that move into profitability, such companies often come to our market. Sometimes what we find is hugely loss-making companies in their growth profile at the present moment may have audiences elsewhere. If you look at the 6 largest sort of IPOs year to date, generally speaking, all 6 of them are in the technology space. So you've got Finabler, Network International, Nexi, Uber, and Lyft. All technology, and I think they're split between tech and fintech. Our report is actually companies to inspire African nations, and therefore whether it's areas of operation, area of primary business, geography, the customer mix, etc., that's all within the continent for the most part. And I think in the continent we enjoy a very, very strong market share. We have 114 companies listed from Africa on the LSE with an aggregate market cap of over $200 billion. We have the most African companies listed on any international exchange. And in fact, if you benchmark us to any exchange globally, we're number 2 behind Johannesburg, which is truly a South African exchange. So of course, all their companies are South African in nature, but we are second in that rank ordering. We cannot comment on any one company because these are private situations. There is some amount of public disclosure on that transaction in the public domain. An easier way to answer that question is perhaps the types of companies that would embrace a dual listing framework. Because you have 2 types of companies that will list locally, regionally, companies that will look to perhaps list only on the LSE, and then perhaps companies that will go dual listing. And I think for the best structured dual listing company, it needs to be of a certain size so that it can take liquidity from both markets. And it also needs to be having quite a global and a geographically diverse peer group or comparable company set. So when you're in that sort of perfect recipe of large cap size and in an industry sector that requires you to look beyond a certain country for the appropriate comp group, is when a dual listing would make sense, because I think the international investors will give you value for a for a global peer group, whether the peer group of that company could be in Korea, Taiwan, India, or the US. Whereas certain regional markets, what we do feel sometimes is that they go for more locally defined peer groups, and sometimes those locally defined peer groups just don't exist as well defined as they exist at the global scale. You should see quite a few pretty substantial, pretty large cap situations from the continent coming on our market. And that's from various countries in Africa. We can't obviously share names at this stage, but on your valuation dynamic that you've alluded to, I think these management teams and these shareholders, what we're finding, are being quite sensible on valuation. So gone are the days when entrepreneurs are trying to perhaps, milk every drop of valuation, because I don't think that's the way to actually maximize the entire stake's worth. Because when you do that, either the transaction sometimes can fail, or sometimes the transaction may perform poorly in the aftermarket. As was alluded to during the panel, sometimes the art in making money for everybody in capital markets, and that's for the buy side to make its returns, and the founders or private equity to make their returns, is leaving a little bit on the table, being sensible about valuation relative to peer group, pricing the deal sensibly so that everything is in favor in terms of its aftermarket performance. And then if you compute the value of the stake that is still with the private equity firm or the entrepreneur, you'll see that is a richer game and a larger game to play, rather than at IPO to try to max out valuation. Yes, a resounding yes, and we've seen that in recent times with the IPO of Network International just recently. I mean, Network International may have a Dubai headquarters and a PLC on top, but a lot of the business is actually a business that is South African and Nigerian and Egyptian in nature. The 5 main centers Network International has are the UAE, Jordan, South Africa, Nigeria, and Egypt. And that IPO went down very well in the London market. But moving on from Network International, the Africa story today is very interesting. The equity investors on the buy side are very engaged on looking at new situations out of the continent. I think, broadly speaking, I can divide the universe into 2 broad generalizations. One is those large companies which have achieved a certain phase of growth and profitability. And those large companies tend to be in a certain kind of, let's say, well peer group, well comped, well evidenced industry segment, where there's a lot of interest from the buy side. And then equivalently, what we've recently seen is there's a lot of buy side interest from companies in technology, in fintech, in healthcare, etc. And in some of those sectors, what we find is that perhaps the companies are not mega cap, perhaps they're not already at, huge levels of profitability. But I think the Africa story is well understood amongst international investors for them to take a view on those sectors, even if the companies are not as big as the former set of industry groups I had outlined. We've seen a huge amount of demand from the fixed income buy side to buy sovereign paper, whether it's from Africa, the Middle East, or India, frankly. You noted the Kenyan sovereign bond from last week for about $2.1 billion, which went down very well. But this was the second time Kenya came to the market in the last couple of years. We've also had issuances and a variety of multiple issuances from Egypt, Nigeria, Angola, and Ghana, just to name a few from the continent. In terms of the corporate world, We had Seplat and Ecobank list recently. Out a little bit further afield from here in Nairobi in the Middle East, you've had the Saudi sovereign issue sukuk. You've had Saudi Aramco issue $12 billion of multi-tranched paper. You've had issuances from the Abu Dhabi sovereign, from Tabreed, NMC Health PLC, Mubadala, Sanat, etc. And just last Friday, the day after the Kenyan sovereign bond came on Thursday, we welcomed a sovereign bond from Kerala Infrastructure Board to finance a certain state in India, i.e. Kerala's infrastructure spend. So the fixed income market at LSE is very deep. It speaks to a very sophisticated buy side in fixed income, and it opens up the largest pool of investor demand for such sovereigns to have a dialogue with. Is all global markets have some instances of fraud. How do we learn from some of those instances to prevent them from newer markets, perhaps? So I think there are. So I think the way business and the way capital market transactions are done in an exchange like London Stock Exchange is that there are many levels and layers of diligence that gets done pre-IPO. So quite often a company would have perhaps attracted some private capital, private investors pre-IPO, and therefore various other market participants can draw comfort from the fact that those private investors would have done some serious diligence to have come into the company. The next level of diligence gets done when the company goes out to appoint its underwriters, its book runners, its legal advisor, and perhaps its transaction services, which are often provided by an accounting firm. And those channel partners, those counterparties conduct their diligence to see if this would be first of all, if it is a legitimate, genuine story, and then how to position it to investors. So you've got another series of parties doing diligence. On a market such as ours, or a market such as the US exchanges, the regulator then reviews the documents, looks at all the disclosure, looks at all the information provided about the company, its operations, its customers, revenue concentration, the board, etc., and does a further level of diligence. And it's not just diligence, but a lot of back and forth Q&A and a comment process that goes on for about 6 to 8 weeks. At the end of all of that, what we generally see is if there has been any evidence of a company that may not be fit for listing, that probably comes out in the wash, and that company doesn't make it through. There is thereafter a further stage of marketing diligence where when the company goes out on the road, whether it's to look at the early look, whether it's to talk to early look investors, pre-deal investors, or generally when the company then with its advisors engages with the buy side, if there is something that doesn't feel right, there will be an inadequate amount of demand for the shares, and therefore the company will not list. So you have, what I'm trying to outline to you is you have a series of checks and balances in place to prevent such instances. Now, do all markets have some instances that occur post-listing? Yes, they do. And that's a little bit of the nature of a thriving, buoyant market. Sometimes there will be errors made through the cycle. And as long as those errors are not systemic, as long as that they are contained, as long as there is a reason why certain processes failed in that situation, the buy side takes the view that this is a risk-reward game, and you get paid for a certain amount of risk, and sometimes it goes a certain way. So I think to your question on how it can be applied in a regional market, it's to try to perhaps import a lot of that diligence procedures, import a lot of the regulatory mechanisms and various counterparties doing those diligence procedures, and even post-listing to ask the company to comply with various ongoing reporting and procedures, such that if there is any evidence, it gets nipped in the bud early enough before investors lose money. So I think your question is just the education and then the acceptance of kind of independent boards and professional management teams sometimes being put into companies which otherwise perhaps sometimes are founder and entrepreneur led and with a very non-independent board. And that's something that we come across quite often, not just in the continent or in Middle East or India, but frankly, just with regards to any business going public. And I think that is a little bit of the the company, the adherence to corporate governance, or the adherence to trying to build a majority independent board and incentivizing the board to form the various committees and having those committees provide the oversight to management is a hurdle for certain companies. But I think if they see the fruits of that labor or the fruits of that hurdle in equity value formation thereafter, or how the buy side grips them and embraces them and gives them value for what they've done when they've structured it correctly in terms of management team or board, I think that's how they accept those changes. Ultimately the board is meant to act in the best interest of the minority shareholders. And therefore, yes, there may be a reluctance, but as soon as a management team understands that they're in place to protect the best interests of the people that you've gone out to market your story, I think people are able to get to grips with that change.